Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's program, I have to say we're all preoccupied with Donald Trump. The market sold off pretty substantially, and you can blame Donald Trump and his tariffs for most of that. So tonight, I'm going to ask Junbei Liu of 10 Capital how she's playing Trump. Paul Rickard is going to look at the stocks he thinks look like really good buys because of Donald Trump and his tariffs. And finally, we talked to Chris Hill of AussieX, that's a stockbroker that specialises in wholesale investors and self-managed super funds. And we'll see what the differences are when it comes to advisors and self-managed super fund trustees when it comes to the stocks they like right now and the ones that they are kicking out of their portfolios. So without any further ado, let's now cross to Junbei Liu of 10 Capital. Thanks for joining us, Junbei Liu.
Thank you for having me, Peter.
So Junbei Liu, I think the obvious question everyone wants you to answer is, how do you play these Trump tariffs? Do you wait until there's another leg down, or do you start buying now?
I start buying now. I always believe, look, in any share market, it's always hard to find the very bottom, right? So the way you play it is that you find companies that, well, normally everyone knows a group of companies they want to buy. And then you reassess the current changes in terms of, tariff, the expectations, slowing consumer in the US. Does that actually impact my investment thesis for the companies I love? And often it doesn't. So when it doesn't and a company becomes cheaper, we just start taking our positions. We start buying a little bit at the time. At the same time, though, making sure the portfolio is not too skewed, because you can't just buy one type of business. In this sort of environment, we tend to, for every if it's a growthy business we tend to buy some sort of defensive to go with it, just to make sure your portfolio is all sort of well balanced, because there's uncertainties in the world. You want to or throw your all eggs in one basket, sort of want to have a bit of everything, and then ease your way into the companies you want to buy.
Okay, so have you put your heads together at 10 Cap with your colleagues and made a decision about what Donald Trump might do next, and which is not an easy question to actually answer?
No, it's not. Look, it's not. And he certainly seems to be negotiating out in the public, which is creating a lot of uncertainty. So I think, if anything, so far, you have to be focusing on what he actually really enacted, right? What he actually really put on. So far, it's not that meaningful. If you take into account the tariff he put on China and a few others, it's not that bad at the moment for those economies, and then flow on potential impact. It's really what he says and what he tries to get is creating uncertainty, and markets not sure what he's trying to do there. So I do think that, though, based on what his actions at the moment, I don't think it's that meaningful impact for companies or global growth, that kind of thing. However, one thing is changed somewhat in the last 6 or 3 weeks, is that because of the uncertainty and because he's been so aggressive in his rhetoric, it has impacted consumer confidence there in the US. Consumer confidence, corporate confidence. As a corporate, you don't really want to make too much investment decisions when you're not sure what the tariff look like and what the future competition look like. So I do think that, though, we will have a patch of softer data to come through in the US. So just got to be a bit more careful with the companies that has earnings more exposed to consumer and corporates in terms of spending in the next 3 months or so, just simply because people are a little bit careful with what's happening. But look, does it create long-term impact? No, not really. But just in the short term, just a little bit careful with that sort of companies.
Do you think if that soft data comes through, the market will start saying, oh, the Fed will probably cut interest rates more than we expected, and that's going to be a good lifter for stocks later in the year?
Definitely. So I actually think the market late last week, was very worried about America has a recession. In my view, that's very unlikely to happen, because Fed is sitting there waiting to cut rates. And so the slower the growth, the more the rate cut they will have. So with that already bit of softness, the market is already pricing in maybe 2 or 3 cuts to come through. And that's good for the market. And so in a way, market is actually cushioned, or economy is sort of helped by this, the Fed will potentially cut more rates. So net, I think it's positive for the market. You have soft data, but the Fed is there to support it. So I really think the recession is firmly off the table.
Okay, so we know that lots of stocks are priced a lot better today than they were 3 or 4 weeks ago. Macquarie is a case in point. What have you liked and what have you bought as a consequence of the sell-off?
Yeah, so look at some of the easiest one that during this sell-off is, some of the quality company that's not linked to economic softness, right? So first of all, you saw Promedicus come back in the double digit in terms of share price. It's nothing to do with the result. Was strong, and then if anything, they announced more contract wins. It's just it got sold off because market risk off, and it is expensive relative to others. So you saw a bit of opportunities on that front. So we think that looks really interesting. We bought more of another one, which is quite interesting. We're surprised the share price actually came off, is BlueScope. With all that tariff and others, it actually benefits BlueScope. We've seen the steel spread in America gone up significantly because of the tariff. And these are not the tariff that Trump will use to negotiate things. It's the tariff Trump put in place to protect its local, steel making sort of operations. So, so these tariffs will stay in place. And we do think at the current spot rate in terms of steel spread, BlueScope is come about 20 to 30% earnings upgrade, and yet share price has come off. So, so that's really interesting. We add to it. There's a whole lot of other companies that looks really interesting that we just started to, buying back into them.
Okay, well, name names.
There's plenty of them. So one other ones that we think, sort of oversold is obviously the Zip is come off 40%. Now, Zip has grown, is a high growth company. So clearly high growth companies are all being sold off. I think, at this price, the price is almost halved for the growth. It's delivering over 40% growth. And then even now it's still doing over 30% growth into the second half. Now, there is a bit of question. I think for this one, you just have to, have smaller positions to start with because consumer is slowing down a little bit, just a little bit more careful. But I think recently Cynthia and then she said there's no slowdown that they're seeing in their customer base. So if anything, I think this company will do quite well. Names like that.
Okay, now you've been a big fan. Well, you've had a more positive view on China than others. Data came out today. There was some data last week. What's your current view on a Chinese economic recovery?
I think it's pretty good. And so far, in the last 3-4 months, we've really seen the turning in certainly consumer. High frequency data for consumers has been very strong since November. We've seen the housing data is stabilizing. So that's actually pretty good. And that's quite strong. So all of that together, and particularly more recently, we're hearing more in the last week or so, and then over the weekend is a lot more stimulus targeted towards family and towards consumer. I think it's very positive for it to take place. We're hearing particularly for A2, you have the baby bonus, which is very, very significant, and then rolling out across all major cities. I think that's very significant. We're seeing continued run of A2 share price. I think that will continue to do well. Even Fortescue finally is getting a bit of love back with a sort of stabilization in the housing market. So I do think that China-based businesses will have a slightly better time, just because things seems like the ship is turning, not to the huge extent, but look at all the consumer confidence data is strong. You look at even the share market is done really, really well. Most of the strategists now putting China equity on a buy, so I do think the momentum's turning.
Okay, one last China-related stock, and I won't bring up. I'm sure once upon a time I brought up the suggestion or the report that some Chinese people put Coca-Cola in Grange, but let's not go back to there. But
it's the Pepsi.
And do you still like Treasury Wine Estates?
Yeah, I do. And it always surprised me, why isn't Treasury Wine do better? It's trading on very low multiple, and yet it's growing quite, in the double digits. And China is not, Chinese earnings actually not that meaningful part of the consensus expectation. So which means there's upside, very strong balance sheet. So I do think that Treasury Wine has been left behind. If you overlay Treasury Wine with A2 milk, usually they track each other because they're kind of the China consumer proxy. proxy, but that really just broken down more recently, simply because some of the targeted approach the Chinese government to the baby bonus and others. So, but I think that one's looking very, very, very cheap and give very good growth profile. And a little bit like resources company, there's just so much skepticism about whether China is coming back. I think that potentially that is probably at the tipping point of it being recognized.
Okay, Junbei Liu of 10 Cap Capital, thanks for joining us.
Thank you for having me, Peter.
And that was Junbei Liu of 10 Capital. Now let's catch up with Paul Rickard of the Switzer report to see what stocks he thinks looks like really good value right now because of the Donald Trump tariff sell-off. Well, thanks for joining us, Paul.
Thank you, Peter.
Notice that you raised your seat to try and catch up to me.
Yes, I have.
A bit of personality between you and me. Why not? Now, more importantly, today you've looked at some stocks worth thinking about buying after this most recent sell-off. So what are the three you've come up with? And let's go through it.
I think, look, I'm not sure the dip's finished yet,
No,
Pete, but
neither
I
do
think you've got to use these as a buying opportunity, and you're probably not going to pick the bottom.
No.
Very few of us ever pick the bottoms or the tops. So, maybe you got to look at these things in staging your way in by a little bit, wait and see how it goes. But look, the three stocks I think are really worth looking at. First of all is a super expensive stock in Pro Medicus, which is a Melbourne-based company that's made it big time in the US in terms of radiology software, imaging software, things for automating the scans, how it's used in the practice. It's sold it to its software is now in place in 11 of the 20 best hospitals in the US. It's got about a 9% market share in the US, has hardly scratched Europe and Asia, and it's growing like crazy. And that's one of the reasons it's trading where it is, Pete. The stock is on a multiple of about 200 and something times earnings.
Which sounds very unreasonable.
But, the true believers really like the stock because for a number of reasons. One, it's got incredible leverage. It's got an operating leverage of 71%. So for every dollar it gets in its revenue, it keeps 71 cents. On revenue, about $90 million last half, it made about 60.
That sounds like the mafia.
It sounds a bit like the mafia. Very scalable, no capital, no debt. And it started by a couple of doctors down in Melbourne, and they really haven't tapped the rest of the global radiology market. Just haven't had time. It's got 10-year contracts with some clients, and it's all go. So there are a lot of believers, but it's pricey. And the stock has pulled back from about $300 back to about $235.
Has had a nice rise today.
Look, it's only up about $1.50 today. It doesn't surprise me. I'm not sure the market was ever going to do as strong as the futures said they were. But look, every fund manager owns it. Every fund manager wants more. The question they have is it too expensive? And I think it reminds me a bit like ResMed. When ResMed was sort of like a $7, $8 stock about 5 years ago, you just had to sort of, close your eyes and buy occasionally and not worry about it. It's in the same category. This is a stock to mark down for, one of the stocks to buy.
Clearly, if there is an eventual big market sell-off, Pro Medicus will what everyone will be shopping for. But even now, it does look viable, doesn't it? Let's go to your next one. That was Goodman Group.
I think unquestionably Australia's best property company. I don't think anyone in the market would argue with Goodman. It did really well in terms of very early into the trend about logistics. Pre-COVID, during COVID, we recognised that the whole way that people were going to buy things online was all going to change the way that things needed to be stored, and the companies like Amazon were going to need these massive warehouses and get very, very smart in terms of distribution and how they got goods back out to the consumer. So Goodman sort of became globally a big player in logistics property. And now it's very much into data centers, which is another big mega trend. And it's been putting a lot of money into data centers. So it makes money out of it. It builds things, it owns them,
Yeah.
it sells them off into trusts, it manages on behalf of clients.
Those industrial estates, wasn't it?
Yeah,
Warehouses.
and so Goodman shares have come off a little bit. They got to about $38. They're about 31. One of the reasons it came up has got nothing to do with the dip, Peter. It raised $4 billion back in the middle of February.
Yeah.
At a very, very fine price to the then market price. It raised the money at $33.50. It was, I think, just under a 7% discount to the then market price. Institutions loved it. But of course, whenever we see these big capital raisings, you sort of get this sort of indigestion afterwards.
Yeah,
everyone's got
don't you?
paper, the buying's sort of done, and it's drifted down. And it took a while to drift down, but it's gone back through the price that the institutions paid. So it's now just under $31.
And what are the analysts saying about the company?
Look, analysts are all pretty positive. It's kind of a consensus price of about $37, $38. Look,
About a 20% rise or something?
About a 20% rise, yeah, about 22%, I think, is the number. They like the company. They think, you know, that they know it's on the expensive side of in the property space, but I think they're a believer in the Goodman story. I mean, it's not a interesting about it is it's big offshore, right? I mean, only about 35% of its revenue comes out of Australasia. It's you know, the Americas is big, Europe is big, Japan is big. So it really is an international property company, but it's no doubt Australia's preeminent real estate company.
It's our best of breed, isn't it?
Best of breed, and this is an opportunity. So you may not rush into it, but this is one to mark down if you're looking at how I could deploy some capital. I don't own Goodman, and I don't have much in that space. You know, the share price has come off to make it attractive again.
Now, what about Macquarie?
But Macquarie's the third. Macquarie doesn't need any introduction, but it's come off pretty hard so far during the dip. It's down from a high of about 240 today, just sitting around about $200. So that's about an 18% fall. It's fallen fairly hard. Macquarie is an investment bank, and Macquarie is going to always go at or above market. So if the market gets bearish, they'll sell Macquarie. If the market gets bullish, they'll buy Macquarie. That's the way it works. And you can see that, you know, if you get a look overnight, you see how companies like Goldman and Morgan Stanley are going to trade. Got a bit of a sense that Macquarie will follow suit here the next day. It is more than half its earnings from offshore, and has more than half its staff now overseas. So, you know, while
they're playing foreign markets,
it's a good way to play foreign markets. So the other thing about Macquarie is it does have sort of its super profits come out of two groups. One out of its commodities trading division. It's one of the biggest global players in commodities, particularly things like gas and oil, and has a huge client book. And so the commodities division had a super 2023, but did tough in 2024. It's doing a little more difficult this year because, you know,
China hasn't recovered.
Commodities have come off, gas prices have fallen because of a bit of easing the tension. You know, Donald's saying drill, baby, drill. That also puts more pressure on the commodities prices again. So with that caveat, the commodities sort of trading business is a bit, I won't say underperforming, it's not making the same size of profits.
And low US dollars are good for commodities as well, aren't they?
Yeah, that can actually be a factor. And the other, of course, is that Macquarie has a whole of assets, you know, green energy assets, infrastructure assets, investments in companies, and, you know, which it tends to basically make a profit on. And when it sells those, they go to the bottom line. So it needs sort of the asset sales to sort of keep it going. So Macquarie's had a more difficult year, but the share price is high. It's come back. I think this is one you look at in a dip. It will be affected by market sentiment. Maybe you don't go overboard too much now and you buy some now and you sort of
nibble in.
But I think a company around $200 is worth certainly to think about the buy area.
Okay, good ideas, Paul. That's Paul Rickard of the Switzer Report. If you're a subscriber to the Switzer Report, you can actually read the full story and the analysis there. Thanks for joining us.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. And up next is Chris Hill, who's from AussieX, a stockbroker that specialises with wholesale investors, institutions and self-managed super funds. And we're going to talk about what kind of stocks are in or out with those groups of his clients. Now, let's welcome Chris Hill of AussieX. Well, joining me now is Chris Hill from AussieX. Chris, thanks for joining us.
Thank you, Peter. Good to be here.
Yeah. So for those people who don't know what AussieX is and what it does, just explain it to us in a nutshell.
So AussieX is a stockbroker who provides services to financial advisors and also institutional clients. We also have services that are provided to some retail clients as well. So we offer white label trading solutions. But from a consumer perspective, what we also do is we put out research regularly throughout the year, which sheds some light on some trading patterns and behaviors of both advised and non-advised clients, which is why I'm here today to talk to you.
Yeah, and do you have self-managed super fund clients as well, or do they come through the advisors?
We have both. So we've got self-managed super fund clients on both our advised and non-advised desks. So we do see many self-managed super fund clients through the advised space, and certainly that's something that's grown over the years in line with SMSF growth more generally.
Yeah, I guess if a self-managed super fund came through advisor and then left the advisor to manage it themselves, you wouldn't say goodbye to them as a customer.
Not at all. We love them, Peter. We'd never say goodbye.
Yeah, especially the more money they had and the more trading they did. Why not?
Absolutely.
Absolutely. Now, but you guys have done a survey looking at what advisors and self-managed super fund investors are liking and not liking now. Is that right?
That's right. Yeah. So what we conduct this research regularly throughout the year, and we track our trading habits of our advised self-managed super fund clients and our non-advised clients as well. And certainly, what we've seen in February was a bit of a change from the norm. Usually, in the top traded stocks, we see a lot of, particularly on the advised side, we see a lot of the banks and a lot of the mining companies. And certainly in February, that was different. We saw advisors particularly selling out of some of the larger banks. I think after CBA's record run, some advisors were looking to reweight in those aspects as well. So it was certainly a different top five trading or top five stocks in the advised trading than we've seen more generally.
Well, I know in my correspondence to our subscribers to the Switzer report, I've been predicting that a rotation would eventually happen. The CBA did make me look like a bit of a monkey for a short time because I was recommending people getting out a little bit below the price it topped out at. But we are seeing this rotation now. And what were the stocks that advisors and self-managed super funds started to like after they started to unload their banks, and probably JB Hi-Fi as well, because that would also hit an unbelievable high?
Yeah, absolutely. So we saw generally with advisors in the advised book, what we see is diversification across the companies, but also sectors. So the reweighting out of the banks and out of the miners was probably part and parcel of their portfolio reviews of their client bases. So what we saw them move into was more Telstra, CSL, Goodman Group was also on there, and BHP was one of the mining stocks that did retain that top 10 spot.
Yeah,
Yeah.
because the top 20 kind of left the miners behind, didn't they? Because they're traditionally. So I guess it's a good sign for the market that some of the leadership group, as some drop away like banks, it's good to see that the miners are falling into favour. Was there a big difference in the attitudes of advisors compared to self-managed super funds?
There wasn't, generally speaking, the reweighting, if you like, of the advised book and the self-managed super fund book was pretty similar. Again, we saw Telstra and CSL in those. I think the disparity was probably between the advised and direct investors. So those not receiving advice from any particular financial planner or professional, where we tend to see more focus on or less diversification, I should say, from a sector perspective. They tended to focus on resources, where obviously advised and advised SMSF clients, there was certainly a lot more diversification there.
Yeah, I noticed that in your press release that if you do compare the top 5 buys from self-managed super funds, it was CSL, BHP, Telstra, Woodside, and Goodman Group. while when it came to the advisors, it was Telstra, Goodman Group, CSL, Centre Group, and BHP. So the difference was the advisors like Centre Group, but the self-managed super fund directors like Woodside. Two companies that probably will do okay, judging from what the analysts are saying.
I believe so. Yeah, I just think it was probably just a case of. I mean, we saw the four of those top five were very similar, and across the top sort of 10 and 20, there are certainly similarities across them. But yes, I think Woodside was obviously a favourite of the self-managed super fund cohort there.
Yeah. Well, is there a bit of an attitude at the moment, Chris, that uncertainty has crept in, and therefore the actual buying of stocks has come off the boil over the last, well, since February 14? That was, if you look at all the high flying stocks, they started falling on February 14, and that's when Donald Trump really got serious about tariffs.
Yes, well, I think when you insert the word Trump into anything, there's going to be a bit more volatility and a bit more. Okay, let's just sit back and see what happens, and that's certainly been the case with what we've seen in the markets on both advised and non-advised. I think it's important to remember that, you know, in terms of the stock market, it does tend to follow economic cycles as opposed to political cycles. We look at Trump's first term compared with, you know, the last Obama term. They tended to be on pretty similar returns there across the share market. But nonetheless, I think it would be an extremely naive thing to say that Trump's not going to have an impact on the share market. I think certainly from a steel production perspective, what we do tend to see is that has more of an impact on the steel consumer rather than the actual manufacturer. But I think when you look at the downstream effects of things like that, the fact that a 25% tariff on steel imports going into the States is going to have potentially a double whammy impact on people who are using the steel for manufacturing, where A, they'll be paying more for it, but B, that will have inflationary impacts, which may potentially impact any future rate cuts.
One last question, mate. Have you seen over the last 5 years an escalation of interest in exchange traded funds?
Absolutely, huge interest. So I think that's grown exponentially from the data that we're seeing. Interestingly, what we've also seen recently, and we did a bit of research into it, was in terms of fixed income, particularly since the announcement of the removal of the bank hybrids. We've seen a lift in fixed income ETFs. I think it's 55% increase year on year. So the likes of your beta shares and your Vanguard ETFs, focusing on the fixed income and the hybrids, are certainly done extraordinarily well with Aussie investors. So
for someone who doesn't really understand how you get an ETF out of a fixed income, are you saying that there's like an accumulation of bond funds all put into one trade?
Yeah, absolutely. So rather than, obviously you can still go direct and get access to your bonds through those different sources. But in terms of if you're jumping online and you want to reweight out of something and you've got an interest in fixed income, then there are a number of ETFs there that are available, which give you that diversification without having to make the substantial investment directly into bonds if you don't have the capacity to do that.
All right, Chris, well, thanks for joining us. We'll catch up later.
Thank you very much, Peter. Appreciate it.
Cheers. That was Chris Hill of AussieX. So that's our program for today. Thanks for joining us. Don't forget, if you want more information than you get on this television show, think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. See you next week.